calm down before you stress up the groove. The energy a little different when the blessings.
Hey everyone, welcome back to the Venture Kills Vlog Season 2. I know it's been a hot second, as my teenagers would say, since I did my previous episodes. My apologies, I just got busy with my real job. The good news is I've got a ton of great content planned for this season. The even better news is we have a new camera. Now you might think, hey Moody, the old camera seemed fine, but I can assure you this is much closer to my natural skin tones than this. Also, Sony has this feature where the camera will take off like 30 pounds. I don't know why they don't promote that more. Anyway, there's two pieces of good news. The bad news, unfortunately, still the same face in front of the camera. So up to this point, I've mostly talked to the viewers of this fine channel about things that founders should consider when they're building a company and they're managing their teams. But today I'm mixing it up. I'm going to actually talk to the people who do all the work at startups, the employees. Power to the people. So today's topic is employee stock options, which is something that confuses a lot of people. And I think this message, even though it's for the team members, people that are thinking about joining a startup, it's hopefully going to be helpful to some of those leaders and managers, because I know plenty of folks that issue stock options to every one of their employees, and yet they still don't know how they work. People tend to get bogged down in all the nuances and details, and there are a lot. We're going to take a little different approach here. We're going to make sure we focus on the big picture, and we're going to do that by answering the one question that's on everybody's mind when they're trying to figure out stock options, which is, how much are my options actually worth? So are your options valuable? Probably not. No, I'm sorry. They probably are. I've always wanted to say that when people ask me. The thing is, in order for us to understand how valuable they are, the first question we should ask ourselves is, do they have any value at all? And if they're going to have value, three conditions have to be true. So let's focus on those three conditions first. Number one, your options have to be vested, and we're going to talk a lot more about that in just a second. Number two, you have to have an opportunity to exercise your options. This is probably the one that's most overlooked, and again, we'll get into that in just a minute. And number three, you have to be presented with an opportunity to sell your options to a buyer at a price that's higher than the price at which your options were granted. That's also known as the strike price, and we're going to get into the bulk of that in the next episode, but we'll touch on it a little bit today. So again, let's look at this first one about your options being vested and two, exercising your options in this episode. And then shortly after, I'm going to follow up with an episode around that third topic. So what does it mean your options have to be vested? Basically, it means that your new employer expects you to actually earn these things in order for them to have value. They don't have value on day one. I know, bummer, right? So how do you earn them? Well, the most common way is that you work at a company for an acceptable period of time. So what's an acceptable period of time? Well, that's determined by something called a vesting schedule, and it should be detailed in an offer letter if you're joining a new startup. If it's not in the offer letter, definitely ask for it because it matters. So at this moment in time, by far the most common vesting schedule is a 4-year vesting schedule, meaning you're going to earn your options over a 4-year period. But the thing you should know is that almost every schedule starts with something called a cliff, which means you're going to be working and not actually vesting your options until you hit this cliff period. And right now, the most common cliff period for a new employee option grant is 1 year. So you're going to have to work a year before any of your options vest. Now, why is there a cliff? Essentially, startups hire lots of people, especially fast-growing startups, and they're naturally going to make some bad hires. And so the company doesn't want a bunch of bad hires to be shareholders, so they kind of want a proving period. And this period up until the cliff is your proving period. Now, if you make it to the cliff, the company is effectively acknowledging that you weren't a bad hire. So congratulations on that big milestone. Be sure and add that to your resume. So the good news is once you hit your cliff, you effectively get to catch up on all the options that probably should have vested. So let's say you had a 4-year vesting schedule and there was a 1-year cliff. then in that situation, since 1 year represents 25% of 4 years, 25% of your options would vest on the day of your 1 year anniversary. So you do get to catch up if you prove to be not a bad hire. This may or may not be confusing. Let's just look at a simple example. Let's say you join a company, they have a 4-year vesting schedule with a 1-year cliff, and you're granted an option grant of 4,000 options. So if you quit before a year or they fire you before a year, none of your options will have vested. But the moment you hit your 1-year anniversary, in this scenario, 25% of your options, or 1,000 options, will vest automatically. And then after that period, you're going to vest typically monthly for the remaining 36 months. So in this case, the remaining 3,000 options over 36 months, I think that comes out to something like 83 options per month will continue to vest until you hit your 4-year anniversary, when all 4,000 of your options will have vested. Okay, a couple more quick points about vesting, and to be clear, this is starting to get into the details, and we're definitely not going to dwell on the details in this. The first thing you should know is, although a 4-year vesting schedule with a 1-year cliff is the most common, there are definitely lots of different varieties. So again, make sure you understand what vesting schedule you're signing up for. Another thing that's worth mentioning is that not all vesting schedules are time-based. In this case, I said the way you vest is by you kind of earn them over time, but there are option grants that can be more performance-oriented, for whether they're company performance or individual performance, where your options might vest on certain milestones, for example. But these aren't super common. They're definitely not typically part of a employee option grant program, so we're not going to focus on those. I just wanted you to be aware of it. Another thing that's worth mentioning is it's not uncommon to have multiple grants going on at the same time. So let's say you join a company and you're really happy and doing a great job, and the company thinks you're doing a really great job. You know, somewhere, who knows, maybe your 2nd anniversary, your 3rd anniversary, they'll say, hey, we think you're doing a great job. We want to give you a new grant. Now, your current grant's still valid. It continues to go and continues to vest. If it's a 4-year vest and it's in year 2 or year 3, you've got some ways to go, and you're locked in at that price. But then they'll give you a new grant. Now, this new grant might come at a different price if the company has increased or decreased in value since your first grant, and it might also come with a different schedule. The main thing here to know is you shouldn't think about a company as, hey, when I join, I'm going to get a grant, and that's my one opportunity to earn equity in the company. There might be multiple. I've certainly seen situations where individuals had 5 or 6 active grants all vesting simultaneously, which is a really great place to be. And finally, I'll just briefly mention that there might be circumstances where your option schedule kind of accelerates to a next point. Now, again, this isn't super common. Sometimes it happens when the company goes through a change of control. But again, we're not going to focus on that. Just know that if there's an opportunity for your options to accelerate under certain conditions, that will absolutely be laid out in your offer letter. I just wanted to mention it so you're aware, because it does apply sometimes, particularly in certain positions. The summary of this whole thing here, if you're going to take one thing away around vesting, is only vested options have value. Unvested options are totally worthless, although I'm sure their mothers still love them. Hey guys, sorry to interrupt here. I'm coming to you from the future where I've been editing this video, and having watched the content a few times, which is required when you're editing, I thought it was important to pause and just say employee options can be really awesome. They're one of the many compelling reasons to consider joining a fast-paced startup. For many people, they're one of the most compelling reasons. Employee option grants have created enormous wealth for a huge number of people. So you absolutely should be excited when you get a new option grant. So why am I saying this now? Because I realize in watching this video, it's important to be very pragmatic, which is what we're doing. So I've used terms like worthless a whole bunch of times because I'm just trying to help you understand the foundation. I don't want you to make a poor financial decision because you have a perception about the value up or down of your options that may or may not be true. I don't want you to make a dumb mistake in terms of how you think about your vesting or when you exercise, those types of things. So we have to get through this foundational stuff. But in the next episode, I'm going to get into the exciting stuff of why these things could be worth a lot and why you in fact should be excited about them. So hang in there. I promise we're going to get to that in the next episode, but watch this one carefully, because if you don't get the foundation right, that other stuff won't matter at all. Okay, while I have your attention, one last thing. If you're enjoying this content, please consider hitting the like button down below. Hit the subscribe button. If you hit that bell notification, you'll get a notification each time I publish an episode. And most importantly, if you have anything to add to this conversation, please consider adding a comment down below. Maybe you have some questions about something I said, or maybe you disagree with something I said. Please let me know in the comments down below. Okay, back to our regularly scheduled program. Okay, let's move on to the second condition that has to be true in order for your options to have value. Now, when you first join a company and you get an option grant, you're not a shareholder in the company. Now, you might be thinking, yeah, Moody, you already covered that. You see, I haven't worked there. I haven't earned them. I got to go through this whole vesting schedule, and then I'll be a shareholder. Actually not. You're still an option holder at that point with some vested options, but you're not actually a shareholder. So you're probably thinking, how do I actually become a shareholder? We see an option grant is just that. It's an option for you to buy a certain amount of shares at an established price, that strike price. And you decide whether you want to exercise that option by actually buying the shares at that price or not. Now, why would you not exercise your options? Because the value of the stock might be lower than the price that you were guaranteed to buy them at. And in that case, there'd be no reason to exercise your options. But in order for you to go from being an option holder into a shareholder, you have to exercise your options, which again means you have to buy the shares at the strike price that the options were granted to you at. Okay, so let's talk about the most common timing around exercising your options, and then let's also talk about how people can get this wrong and find that their options are worthless because of certain scenarios. So by far the most common timing around exercising your options is when a company has a liquidity event, which typically means the company's being bought by another company or the company's going public. So let's talk about that first scenario where your company is being bought. Now let's say you originally granted 10,000 options at a $1 strike price, and this liquidity event is happening after your 4-year anniversary. So all 10,000 of your options have vested. At the moment you're selling the company, you will be able to exercise your options, which means you're going to pay $1 for every option, and you're going to get shares in exchange. And so you'll ultimately pay $10,000, and you'll get 10,000 shares in return. Now, let's say in this scenario, the buyer is buying shares of the company at $10 a share. So effectively, the value of your stock at that point will be $9. So $10 offer price minus the $1 strike price times your 10,000 shares, or in this case, $90,000. Now, in reality, you don't actually have to write a $10,000 check. The lawyers and the accountants, they do that math for you as part of the transaction. So in this case, you would just suddenly end up with a $90,000 check. So that's by far the most common scenario. It's worth noting, and again, we're not going to talk about this because it's beyond the scope, but that's not the most tax efficient way to exercise your options. I'll touch on it just a little bit more in just a second. So there are other ways that you can time the exercising of your options. That just happens to be the most common. So let's talk about how you can get this wrong, or how your options can turn out to be worthless. By far, the area that gets messed up most often is around when someone departs a company. So when you're leaving, there is a window of time after you've departed in which you can exercise your options. And if you don't exercise them in that window, then they are actually returned back to the company, and the company will turn around and issue those to another new employee or an existing employee. Now, the typical exercise window upon departure is 30 to 90 days. There are plenty of exceptions, but but that's kind of the most common window. So you've got 30 to 90 days to decide whether you want to exercise your options. Now, why wouldn't you exercise your options? Really, two reasons. One is you're not certain that the fair market value of the stock will ultimately be higher than the stock price at which you were granted the options. This is super common in the case where you left the company because you were laid off and the company's really struggling and you think the company's worth less than when you joined it, then you wouldn't be incented to write a check to buy something at a higher value than you think you can ultimately sell it. And the second one, which is super common, is you may not have the cash to exercise your options. Let's take a scenario where you join a company and over time you've got 200,000 vested options at a strike price of 50 cents. And you're leaving, maybe you were fired, who knows, but you're leaving and you're just confident this company's going to go public in the next 1 to 2 years, and you're sure the value is going to be at least 30x your strike price. So you might be in this scenario very motivated to exercise your options. But in order to exercise them, you're going to have to write a check to the company. If you wanted to exercise all of your fully vested options, all 200,000 of them at the 50-cent strike price, then you'd have to write the company a check. And that check would have to be $100,000. So in this case, you, one, need to have the cash, and two, you better be damn sure that the company's ultimately going to have a fair market value over the 50-cent strike price that you're paying. Okay, a couple other quick notes about exercising your options. So when can you technically start exercising your options? Forget about when you would. When can you technically do it? In most option plans, you can start exercising your options as soon as they vest. So if you have options that are vesting every month, you could be exercising them as they vest. And in some cases, it's worth noting some stock option plans actually allow for an early exercise period, so you can actually exercise your options before they've even started to vest. So why would you ever do this? Why would you start exercising your options before you know that there's a fair market value out there that's going to be higher than your strike price? Why would you take that risk? The short answer, and again, we're not going to dwell on this, is taxes. There could be some tax advantages by turning your options into shares and then holding those shares for a period of time before you actually sell them. You might get some long-term capital gains treatments. So again, if you're curious about all this stuff and you're about to join a company, you want to understand how it works, get some real tax advice. Don't listen to me. I'm not giving you advice. Go out and talk to someone that understands this world and they can explain this, because there's definitely plenty of risk and reward trade-offs that you're going to have to decide to make. Speaking of taxes that we're not going to get into, you should know that there's two different types of stock options. There is incentive stock options, or ISOs, and then there's non-qualified stock options, or NSOs, or some people call those non-quals. And ISOs are typically given to employees. NSOs are typically given to employees, but they also could be given to advisors and partners and things like this. They're treated differently from a tax perspective. ISOs have a more favorable tax treatment traditionally. You likely won't have any say about whether you get ISOs or NSOs, but when you receive your grant, again, get some good tax advice. The last thing that's worth mentioning is that there is an emerging trend, especially in the Bay Area, where companies are giving that departure exercise window a very long period of time, maybe in some cases years worth of time. Now, that's obviously a very generous policy for former employees. There are some trade-offs to that beyond just being generous. There's some downside risk for the company and investors. So it's emerging, but it's definitely not common. Right now, the most common window I see is a 90-day exercise window upon departure. So again, in summary on this second point, options that have not been exercised technically have no value. You have to exercise your option, convert your options to shares, and then your shares might have value if somebody is willing to buy them above the strike price that you paid for them. In this episode, we focused on two conditions that have to be true for your options to be worth anything. And that is, 1, your options have to be vested, and 2, you have to exercise your options and convert them into shares in order for them to have any value. If they're unvested or they're unexercised, then at that moment in time, they're technically worthless. Now, in the next episode, we're going to talk about, assuming your options are worth something, how do you decide what they're actually worth? And that episode's going to come really soon. Don't worry, you won't have to wait very long for it. That topic is actually surprisingly meaty. It's not, yes, it is simple math, but the nuances of the math actually there really matter. So I wanted to have a whole episode focused just on that. Again, coming really soon. Okay, the final thing I wanted to mention was right at the end of season 1, I talked about a Venture Kills t-shirt giveaway. I haven't forgotten about it. Have already figured out the winner, the people that subscribed and made comments. So I'm going to be reaching out to you and letting you know that you won really, really soon. Apologize for the delay on that. Again, I just got busy. So thanks so much for watching. Don't forget to like and subscribe, and we'll see you on the second part of this whole employee option journey really soon.